All right. So like I mentioned, I do have some notes here that I want to pull up. So let me do that. Just a bit of notes. So like I said, today my main goal is going over that transition from backtesting to live trading. Let me pull up chat here just to make sure there's any questions as well. And obviously, if you guys have any, you could type it in chat. I'll stop and get to them. So feel free to stop at any time. I don't mind at all. And the first thing I wanted to talk about was this is probably one of the more common ones that I find from students when I do get a message regarding this. And it is not having enough data or repetitions in the live market to conclude anything. And the reason I include this one first is it might sound very, very common, but I do feel like it's one of those things that some people don't necessarily realize it. There is some psychological factors going on here as well that cause this. Let me know if you guys can hear me well, too. I have my mic set up in a different area than typically for this webinar, but I do want to talk about it because one of the first and main things that I find when people come to me with this specific scenario is that, for example, let's say someone has backtested 500 to 1,000 trades. You know, it's a great sample size, fantastic data, and a trader should be very confident after that many repetitions and getting an idea of their system. That's a very, very substantial amount of trades. You should have an idea of your data, your drawdowns, etc. However, with these new flashy prop firm evaluations, what I find very common, and this may apply to some of you or some of you in the future, so keep this in mind, but they go and take their first prop firm evaluation, or maybe their 10th, regardless of where they were before and how many they've taken. And very, very quickly, you know, they might be down 5% in that challenge, and they come to me asking why they're not doing as good on live as they were in backtesting. And I do think it's one of those things that is definitely emotionally driven. Being down 5% in a live challenge where there's money on the line psychologically is very, very different than being down 5% in your backtesting over the course of 1,000 trades. I can personally tell you over the course of 1,000 trades, you will hit 5% drawdowns 100 times probably. Maybe that's a bit of an exaggeration. I would say 50 is even a reasonable number in this case, but 50 periods in that 1,000 trades of data could easily be a 5-trade losing streak. It is very, very, very common, depending on your win rate, of course, and how you manage trades. But typically for myself, 5-trade losing streaks happen all the time. My last one that I can think of would have been July. But obviously I don't take as many trades as the majority in this group. I'm very conservative. But in July, I took about a 6-trade losing streak. And then, of course, I had a fantastic month in September. You guys know that. I had a great month in August, so it did end up making up for it tenfold. But, that's part of trading. If I were to take that 5-trade losing streak in July and then get upset about it, 5 or 6 trades, I think it might have been 6, but we'll say 5 because of this example. And if I were to take those losses and get upset about it and immediately go to the drawing board and say my plan doesn't work, I would have not been able to make the money I did in August and September following that. And even October has been a relatively slow but still successful and profitable month for me. Not as many trades in October as I had in September and August, but overall I'm still up. We'll actually go over some of those trades a little later in the webinar and check out the live charts. But I do want to mention this because, as I talked about, it's very psychologically driven and emotionally driven. If you have 1,000 trades of backtested data, you cannot get upset and make conclusions in your first 5 live trades, first 10 live trades, and honestly, in most cases, even 30. Because when we tell you guys to collect a sample size of data, we usually say a minimum of 50. In some cases, you'll hear a minimum of 100, and these are minimums. You have to approach the live markets the same way. You cannot collect 1,000 trades of data and then the live markets come around and you've only traded for 2 months and have maybe 10 trades under your belt and then draw a conclusion that you are not doing as good in backtesting as live. Now, number one, it is very, very common your first few months, we're going to talk about this a little more, are going to be much, much worse in the live markets. There's an adjustment period. But I do want to preface this with the idea of just not enough data, to kind of just get that out of the way and help you guys understand that your first 2 months of live trading can't be something that gets you upset. It's essentially a whole new playing field that you're entering from backtesting. And another one that I don't think applies too many to people in the server here, but it can be common to some of you, is not enough backtesting data in general. I understand that not having enough live experience is one end of the spectrum that I just mentioned, but if you do have less than 50 to 100 iterations of your strategy in backtesting, you simply have not had enough repetitions or experience with that method to then go and assume you can apply it to the live markets perfectly. What I will say is I do always recommend people to backtest and demo trade at the same time. And I do think this gives you the best of both worlds at the same time. There's nothing that hurts about opening a demo account and practicing, but as long as you can psychologically remove yourself from the results. Because I promise you, if you're opening a demo account with a brand new strategy, if you can psychologically tell yourself, okay, I know it's going to be rough for my first 2 to 3 months. I don't know the strategy that well. I shouldn't be in prop firm challenges, etc. I think it's very, very important to psychologically remove yourself, but you will learn at 10 times the rate of the person who just backtests 1,000 trades and then hops onto a demo account and they're at square one, brand new to the live markets. They are going to perform much worse than the person who's just taking their time on backtesting and demo at the same time, understanding that there's going to be drawdowns, there's going to be rough periods, you're not a master of your strategy yet, but utilizing both at the same time will exponentiate the speed that you will achieve profitability and, more importantly, mastering that trading plan that you're using. That is one very, very important aspect to it. And the next one I have here in my notes is not a strong enough understanding of your actual data. So this one's big, because it's another thing that psychologically we tend to forget. I know a lot of people will backtest their trading data and they will see, for example, 9% drawdown periods. However, if they hit a 9% drawdown period in their first 2 months, which is common because, like I said, in your first 2 months or 3 months on a live chart, you're going to be trading much worse. You're going to take unnecessary losses. You're going to accidentally miss winners. You're still learning the plan in a live market, so you are going to perform worse. However, they go and have a 9% drawdown in their backtesting, but then once they hit a 9% drawdown in live, it is the end of the world and their strategy no longer works. I understand that there's an emotional aspect to it there, where one scenario is completely fake data and the other scenario is something that the future is unknown. It's very important, but if I backtest 1,000 trades and I look back and see that there was a 9% drawdown, the emotional and psychological part of my head says, well, at the end of the 1,000 trades, I made so much profit that it didn't matter. However, in a live market, if you're down 9 trades in a row, you might not have that long-term perspective of, well, after 1,000 trades, I was extremely profitable, so it doesn't matter. It's much harder to think in that aspect, but it is very important from a psychological standpoint to be able to understand and really internalize the data that you have collected and understand that your goal is to map that as close as possible when you do get onto the live charts. And no, it will not happen right away either. That's very important. And then another piece that I wanted to talk about here was transitioning in that specific transition phase from demo to backtesting. So I did touch upon it a little bit regarding trading demo and backtesting at the same time. I highly, highly advise this, because the person who spends 1,000 hours backtesting but then jumps onto a demo account, he will trade worse than the person who has 100 hours backtesting, 100 hours demo. It's just how it goes. One of the metaphors or analogies that I've always explained to some students in the past is, if you were training to be a professional football player, for those of you that are American here, I think I might be the only one, but soccer, football, we'll call it football for all of you because most of you seem international. But if you are training to be a professional football player, if you spent 1,000 hours with a notebook and a notepad watching film, which many professionals do this, if you spent 1,000 hours watching film with a notebook, you would be highly educated, you would understand the game at a fantastic level, You could even have a coach holding your hand there, like myself, on the sidelines and explaining what's happening in XYZ scenarios on the pitch, how they're playing, why they're playing certain ways. All of this is an extreme amount of knowledge that you are gaining. But I promise you, when you move from that notebook and all that 1,000 hours of studying to day one on the pitch in a real live game, of course, it's a very, very different scenario. And you cannot expect that you are going to play just like you've seen in film. It's the same exact scenario with backtesting and live trading. Those of you that backtest 1,000 trades in a row, it almost can create an overconfidence. So when you do get to game day and you hop on the live charts for the first time, you're almost overly confident in your abilities without quite understanding the other variables that are at play in the live markets as well. I think this is super, super important because starting off on the wrong foot in the live markets and not having a realistic understanding that, yes, it is going to be much harder than backtesting, and there's all these nuances that you have to work out, can get you off on the wrong foot and also lead to you being discouraged much, much sooner. And as we know as a trader, if you are already discouraged on month 1 or month 2 of the live markets, you are in for a world of hurt in the long run, especially for those that are prone to switching strategies, changing things up because they simply do not trust their plan anymore. I see this very, very commonly with students who will backtest a huge, huge amount of data for even years. And then they hop onto the live chart and they're extremely upset with themselves because they've taken a 5-trade losing streak out the gate. It is very, very common for this to occur. It's because of that new scenario that you're putting yourself in. You're not mentally used to live markets. You're not mentally used to, having to wait for this setup. For example, I'm in NZD CAD at the moment, a trade. You might not be used to having this enter and then having to go, to school or to work after that and have this playing out in the background. In backtesting, you click a few buttons and this is just zooming right to TP or stop loss and you already know the outcome. No psychology, no patience necessary there. However, it's very, very different in a live market. Another example is you don't know if you're going to be on the charts at the time when this specific setup occurs. Maybe that week you take off, for example. All these little things can definitely affect your edge in the long term. And it's just very important to understand that the live markets for demo trading, the live markets compared to backtesting is a very different field. But I want you guys to make the transition easier. Number one, on yourselves mentally, because I think that's probably one of the biggest factors is the mental aspect of the transition is actually sometimes harder than the actual analytical side of it where it comes to knowing your trades, knowing your setups, etc. Because I think if you have sufficient backtesting data, most of you understand what you're looking for when you hop onto a live chart. You know you need a liquidity sweep. You know there should be a fair value gap, a break of structure in a nice range that you want to trade. Maybe avoid consolidation periods in the market. These things are very, they're apparent. Everybody here knows them, understands them. We all trade very similarly as well. The majority of us swing traders here. However, when you hop onto a live chart, there's a lot more variables that come into play that some people tend to forget. And they start taking these losses much harder on themselves or the initial period of that transition much harder emotionally than they do analytically. One more piece I want to talk about. I did touch upon plenty psychological factors already. I just have a little bit more that I wanted to list in a more concrete way that you guys can understand because, I've been a mentor for probably 3 to 4 years now. I don't even know how long. It might be 3.5 years I've been a mentor and teaching people in the markets. And one of the main things that I've heard a million times over, and it's perfectly understandable because, I was the same way. Let me make sure I'm not missing a question. Someone pinged me in chat. I'm gonna answer that after because it's not a webinar related question. I lost my train of thought. So one of the things I was talking about is I've told so many students in the past about psychology, and I know Sven pushes the importance of psychology, and I know Andre pushes the importance of psychology. It is probably the last main factor to a trader's success. However, I promise you, I've heard a million times from students and people that I've taught, oh, my psychology is fine. It's just I don't understand breaks of structure. Or, oh, my psychology is fine. I just don't know what a liquidity sweep looks like. Or my psychology is fine. I'm just not doing good on a live chart. I hate to say it, but the majority of the time, subconsciously, it is your psychology that is causing those issues. At the end of the day, we all understand breaks of structure are fairly simple and straightforward concepts. The issue is when you take a losing trade that had a break of structure that you thought was very clear, it now makes you question that break of structure. People will say, oh, maybe it wasn't good enough, or maybe it wasn't strong enough, or did that even break that structure? Is that internal or external? All of these extra questions, and you guys are probably very familiar with those questions too, are just things that are created more likely than not from the psychological factors that happened after a trade has lost or in a scenario of drawdown. Another thing is liquidity sweeps. They are fairly simple and straightforward. I understand they can get complex in some scenarios, but at the end of the day, you have 1,000 trades of backtesting. You should be able to look back at and say, oh, okay, this looks just like this liquidity sweep I took, or I took trades without liquidity sweep, so I'm perfectly fine doing that in the live markets. The issue is once that trade now loses, you begin to question, well, wait a minute, was this a good enough liquidity sweep? What does JB think? I can understand this, and of course, like, I was a student at 1.2. I'm going to leverage my mentors as much as I could as well. But I do want to make it clear that using your backtested trades is the backbone to how you should decide a lot of these questions, and you don't want to let your psychology get ahead of yourself and psych you out of this trade. So a great example is I used to do this when I was trading lower time frames, definitely a lot more discretionary. I used to sit here before I even got tapped into the trade, and basically in my journal, my trading journal, would ask myself, is this a trade I would have taken in backtesting? And am I 100% confident and fine that this trade follows my plan? If that answer is not yes, number one, you shouldn't be in the trade. However, if the answer is no, you should also not be in the trade. But what I want to get across here is if you are asking yourself 100% before, is this something I would have taken in backtesting? Then you should be perfectly comfortable regardless of the outcome of this trade. That is a very, very difficult thing for some traders to actually understand because they only ask themselves that question, was it valid after the trade has concluded? And that is a big, big no-no in my opinion. You should not be acting in hindsight. We always want to act before the markets move because one very clear thing is if this trade were to take the stop loss and move bearish, I know there's many, many traders out there who would say, oh, but I don't think this break of structure was clean enough, or, oh, wait a minute, this fair value gap was not big enough, so this was not a valid trade, I fucked up. At the end of the day, it's not you messing up, it is you now taking the outcome of this trade in hindsight and then making an excuse for why it lost, not necessarily understanding that, yes, there is complete probabilities at play in the market here, and no matter what happens in this trade scenario, you should be okay with the outcome before it occurs. That is one of the toughest things mentally to get used to from live trading to backtesting, because in backtesting, it happens in an instant. You set the order, you click through it in 5 seconds, and boom, the trade's done, and you can say, okay, yeah, good enough, next one. In live trading, that all might happen in the course of a week. This trade, by the time it's set up and I had this break of structure, we're looking at Tuesday, October 15th. By the time this even hits break even, TP, or stop loss for me, we could be looking into next week. And it's one of those things that in that whole period of time, you should know well before this trade settles and where it ends up, whether or not it was valid for your trading plan. It's a huge, huge mental shift that has to be made, but you'd be surprised how many of you may not actually have done that or mentally thought that way when approaching the live markets, and it is making that backtesting to live transition much, much more difficult. Another few examples of psychology that can affect certain factors of trading. Number one, and I think it's a big one that some people kind of it goes under the radar, is impatience leading to an increase in orders. So this one is very, very common. It's probably one of the reasons I put it first, is in backtesting. Once again, we're going back to the idea of if I slap a replay tool on this trade, and in backtesting, you might click play and all of a sudden the markets are zooming by. Oh, it tapped you in or whatever. And then let's call it a stop loss. That very, very quick amount of time, it's training your brain to have that short-term gratification or, I guess, settling or closure on those trades much quicker. You have to be able to make that mental shift that it's going to take much longer in a live market. But another very difficult aspect of that is I find people placing more orders because they want more action in some cases. Definitely tougher from the swing trader's perspective. When I was a day trader as well, though, I would hop on at New York Session Open, and I would set my orders on a 15-minute time frame, even a 1-minute time frame a few years ago, and I would be essentially sitting and waiting for a 2-hour, sometimes 3-hour New York Open session and waiting for a setup to occur. The amount of times where I may have gotten bored or impatient and created something out of nothing is very, very common, and that happens on the 4-hour time frame as well. Many of you guys, you hop on for 10 or 15 minutes in the morning, you set your orders, and you walk away. It's a great way to trade. Personally, I do that as well. But the issue arises when maybe 3 days, if not a week, goes by and you don't have orders on the charts. Some people will start to get aggressive and they'll start making something out of nothing and further confusing themselves as well. For example, looking at this trade, I had this order set, I let it be, I had my liquidity, my fair value gap structure, sweep, etc. I will see and get DMs of people who begin saying, well, wait a minute, this is a liquidity sweep, right? But then also this is a break of structure. Okay, but there's a fair value gap right here. So then that means that I should be able to take a sell here from this low to this high because it follows all my rules. In my opinion, you are creating complexity out of impatience, out of, some confusion that doesn't necessarily need to be there. You are not going to perfectly catch every trade that follows your plan. You are not going to catch every single winner, and losers are absolutely inevitable, and you have to accept that. Those three main things and leading to overcomplication is a huge, huge factor. And if you find yourself spiraling, is what I call it, looking at that scenario we just did and saying, wait a minute, should I be buying or selling now? I'm confused. There's two setups inside of each other. In backtesting, I would simply look at this trade, and this is the one I would take in backtesting 100 out of 100 times. I would never take a trade like this in backtesting, so as simple as that, I shouldn't be taking it in the live markets. And the reason being is, number one, I don't like trading within a range that's already established. And it's very simple. One good reason, and I already understand that, okay, I should be a buyer in this scenario. I do get people who, I call it spiraling, some people call it on tilt as a trader. They will be in a trade and they will be completely confusing themselves, or it will be self-imposed confusion, most cases due to psychology and especially impatience. Creating something out of nothing is a big one. There's people who might look at a chart like this and USD Chef hasn't done shit in, I don't even know how long this is, a week or so, maybe nearing 2 weeks. But then they start sitting there and wondering why they're not getting any trades. So they might make up, oh, well, there's a break of structure here. There's a liquidity sweep here if you look at it like that. And then there is a fair value gap right here. So there we go, another setup, low to the high. At the end of the day, I would never take a setup like this in testing. There's no volume present here. The liquidity sweep is very weak, and the break of structure is almost non-existent with almost no candle close above the high. These are the types of things that with 1,000 iterations of your strategy, you should learn to understand and get used to over time. But I will say that psychological factor of transitioning from backtesting to live does make it harder. And that is also another thing that's caused by something like impatience, but I even talk about two more here, which is going to be overconfidence and over expectations from backtesting to live. So impatience leading to a larger number of orders. If you are one person who doesn't know if this is occurring, and because I will admit a lot of times it's very subconscious, these things I'm talking about, nobody looks right away and says, oh, I'm being impatient, and that's why I have so many. In some cases, yes, I'll give you some of that, but in most cases, nobody is saying, oh, I'm impatient, that's why I have more orders on the charts right now, and that's why I'm taking more losses in this drawdown. They're in the drawdown, they're going, fuck, something's not working. It's, they don't think or internalize that deeply or self-reflect. But I will say, if you can look at your journal and compare it to your backtesting, this is something that's happened very common in the past with some students. I've looked at their journal, and they're asking me why they're doing bad in live trading compared to their testing. And 1 month of their backtesting might have 4 trades, and then they show me their live journal for their first month in the live markets, and there's 14 trades, and I immediately can tell them it's an impatience issue or an overconfidence issue because they have immediately fallen off of their trading plan. You're taking 4 trades per month on average in backtesting, but taking 14 in 1 month in live, there is an issue and there's some discrepancy there, and in most cases it is a psychological factor that is completely subconscious. And these are things that, I just want to make aware, because I do think the hardest thing in trading is moving from backtesting to live trading. So a little bit of that does touch upon overconfidence, which was one of my next points that I wanted to talk about. But overconfidence kind of goes hand in hand with what I talked about with an increase in position number. But there is people who, after 1,000 trades of backtesting, they're extremely confident in their edge, extremely confident in their trading plan, but they have never been put under any form of psychological pressure. So now, when you're in the live markets, or you got that funded challenge on the line, or you have a $100,000 account being waved over your head by FTMO, there's a lot more mental factors that are in place than when you had that backtesting session, maybe just 20 minutes, threw on some music and started spamming through charts and collecting trade data, which is perfectly fine to do. You have to understand that when you make that transition to live, it's not going to be that easy. It's not going to be that laid back, because there is a lot more mental and emotional factors that are going to be causing you to make decisions that you would not have in a backtesting session. So one of those things being overconfidence. I think it is a great thing to be confident in your trading plan, but overconfidence, in my opinion, is specifically for the traders that are making that first transition from backtesting to live. And I think that occurs when those specific traders, they hop onto a live chart and they expect exactly what their backtesting data shows. I know Sven talks about it a lot as well. He says, whatever your backtesting data, subtract a little bit from it because there's always human error and emotion. Perfectly great example of how this occurs. But when you are overly confident, if I made 10% in 2 months in backtesting, but hopping on a live chart expecting to make 10% in my first 2 months ever being exposed to that emotional and mental aspect of the live charts, you are in for a more rude awakening than you need, compared to the person who backtests and says, okay, time for this demo account I just opened. Let's give it the best shot I can, but I have to understand that I am going to take unnecessary losses. I'm getting used to this. It's a brand new setting for me. That person will not only do a lot better, but it'll lessen or soften the landing for when they realize that, okay, I'm 2 months into live trading and I'm not profitable yet. What's going on here? It is a very, very important factor to kind of keep your expectations in line, and I guess just in line with reality at the end of the day, because it is very, very rare, in my opinion. Like I said, I've been in the mentoring space for many years. I've never seen a trader who has had perfect backtesting data hopped onto live trading and just smashed it right away. I actually, correct me if I'm wrong, because obviously now I have a lot more students than I used to. I've actually never seen a student, including myself, including Andre, and even Sven being one of my older students. I've never seen a single one pass a challenge or an FTMO evaluation on their first try. And I do think that is, it speaks to what I'm saying here. I don't say that to discourage anyone, of course. And obviously, if you did, you can correct me if I'm wrong, because congratulations, that is a big, big feat to do on your first try in the live markets. But I just put that out there to help you guys understand that even myself, I probably went through 8 evaluations before getting funded. I know Sven, he mentioned probably 10 or so. Andre, I know it's the same. So it is one of those things. It's a lot to get used to the live markets compared to your back testing. But don't be that person who only back tests for years and years, never gives themselves live market exposure on demo. Even demo is perfectly fine for live market exposure. And don't be that person that when they hop onto the live charts, they expect to crush it like they did in their 3 years of back testing. It's just not the case. It's a whole different environment. Another thing I want to talk about now, I think I talked a little bit too much about, specific psychological factors. I want to talk about how to fix this now, or how to improve this, which is obviously the most important part and the most tangible piece of this webinar. And that is going to be how you specifically improve your data. And it's going to be journaling. I know, I used to be a big, big advocate, not an advocate, but someone who was, I guess, lazy with my journal. I didn't quite understand it. I didn't care for it. I would just trade the live markets and it is what it is kind of mindset, see how it goes. And I promise you, a journal, no matter how good of a trader, how professional of a trader you are, you need a journal. I don't care if you've been trading for 20 years or 2 years. A trading journal is the one key that is going to keep you in line as close as possible with your back-tested data. So it is by far the most important and tangible piece of how to get your data as close as you can from that transition from backtesting to live. And when using a journal, I think one of the most important sections is a little note section. I used to always have this as well. And what I would write down is, for example, I talked to you guys about overconfidence. if I noticed in my trading journal in month one of, let's call it, let's go with an underconfidence example, because this is the other end of the spectrum. I talked on overconfidence. Let's say in my back testing, I have 5 years of data, and I look at that back tested data and I see that, okay, I averaged 4 trades per month. Let's say 5 trades per month, for example. But then I get onto my live chart. I'm 2 months into live trading and I have 0 trades. You have to be able to look at your journal and evaluate that compared to your back testing and say, okay, you know what? Maybe I'm being too picky with positions. I'm not trading like I wasn't back testing anymore. It's a live market. There's emotions and now there's stakes on the line. And if you are taking that much less trades, it may be an issue of underconfidence. But the only way to recognize this is by using your trading journal and saying, okay, I now have 0 trades in 2 months. I would already have 8 trades or so on average in my back testing. What's going on here? Your journal should be that first piece that kind of hints to you something is going on psychologically, and you should be able to pivot back and use your back testing data to get yourself back on track to where you should be. Another piece of the journal in the notes section I talked about is that initial transition from testing to live. Inevitably, you're going to take a lot of trades that, to be quite honest, they're shit. You're going to take terrible trades, but it is part of it as well. It's just because you're getting used to seeing things live, not played out yet. You don't get that instant gratification of zooming through the bar replay mode. And, I talked about this U-Chef one as a great example. There is a break of structure here technically. You could force a liquidity sweep. You could call it a fair value gap. Some people might go and take this buy order. At the end of the day, I think most of us here can agree that is a pretty shit setup. It doesn't have a great break of structure, technically not even a candle close. It doesn't have a serious liquidity sweep. It's something that I kind of just drew up to make the setup work. And then it has a break of structure here that's weak and a fair value gap that's tiny. If you're taking setups like these on live trading, it's going to be written in your journal, and you should be able to look back at that and say, okay, I messed up here. This is something I logged down. Keep track of it. Your data, and this is why Sven says, for example, your data is going to look worse in live versus backtesting out the gate, because you will end up taking some shitty trades like this and look back on them and say, man, I really shouldn't have taken that one. Be perfectly okay with that and understand that that's part of the game, because your journal is what's going to really keep you in line on keeping track of this stuff. The more that you say, for example, if I, in my first 2 months, took 4 trades that looked like this, and all 4 of those trades in my notes section on my journal said weak break of structure, next time I see a weak break of structure and doesn't technically follow the plan, I'm going to be sitting out of that trade because my journal says it 4 times and I've taken 4 unnecessary losses by forcing setups. That's the power of a trading journal, especially in the long term. You're keeping yourself accountable, but you're also keeping track of the minor mistakes that you're making on each setup that doesn't align with your backtesting. So when I backtest, I typically, let's go look at some of my more recent trades. I always focus on a strong break of structure. I like these aggressive ones. I like the large fair value gaps or the sweeps on liquidity of consolidation. I talk about these things all the time because I'm super comfortable with my trading plan. Technically, yes, when you look at something like U-Chef, we can force that trade again like we talked about. But I personally know from my backtesting, this is not a setup I have ever or would ever take and want to take in the live markets. The only way to really tell that, though, is through your journal and keeping yourself accountable with time. Because if it were my first 1 to 2 months of taking trades on the live market, I might take this setup because technically it follows all the rules, but it's because I'm not leveraging my backtesting like I should be and keeping myself on track and using that journal like I'm supposed to be. Another thing that journaling is very, very important for is actually keeping track of data, not mental track of data. This is something that I hate that I've had to explain it to people, and personally, it happened to me as well. Especially for strategies that can tend to be on the lower end of the strike rate side. A good example is, as swing traders, we trade roughly week by week. We're not on the charts every single day, maybe. We're not having new orders every single day. So I might, let's say last week, if I took 2 losses and a break even, mentally, I might be like down on 4% on my account. And then going into next week, in my head, I'm like, man, I'm down 4%. Completely forgetting that the week before that bad week, I might have made 8%. But that is completely forgotten 2 weeks, and especially after a bad week, because mentally we hold weight with those negative emotions more than we do the positive ones. And if we don't have a specific track record or the same account that's telling us, okay, here's how our data panned out over 6 months versus I remember last week being pretty shit, so hopefully this week's not shit. The difference mentally is massive having that track record, and especially for those of you that are using FTMO evaluations or just, prop firm evaluations in general, or for some of you that may even be on a FTMO demo account that closes out in 2 weeks. You can't sit there and fail that one FTMO demo account after 2 weeks and then go into the next one and, starting from scratch. It's not necessarily how it works. Another example is you could pass an FTMO 1 week, but then blow on the next week. Does that mean that you're a failure of a trader because you blew the account? No, it just means that the week before you made profit, the week after that you were negative on the account, and obviously it should pan out to be roughly break even or positive in most cases because that's how an edge works. If you're looking at things from very small perspectives, challenges are only used to be like a month long. It would be a 30-day period. There's so many times in my trading career where I've had a negative month. It doesn't mean that because I blew the challenge or failed the challenge, my strategy doesn't work. It simply means I'm not giving it enough time to pan out and play out how it's supposed to. That's another key aspect of having a journal is you can continue that journal on past all your challenges. My FTMO challenge is a month, and then, let's say I fail it or I win it, I go right into the next month with my trading journal, and I can see how that equity curve and data pans out over time. The same way most of you guys would approach your backtesting as well. And then I guess my very last point here, talked about unnecessary losses. I'm just looking through my notes that I wrote down. Okay, and then my last one is not relying on backtesting data enough. So this one is key, not necessarily from a data standpoint, but I think a analytical standpoint. And it's going to come down to really looking at your trades versus your backtesting and kind of answering all unanswered questions using your backtesting. There is a little bit of discretion between the way I would trade and Sven would trade or Andre would trade or even any of you guys. I don't know if you've gone over it before I joined, but a question. Would EuroCAD most recent bullet be considered internal? So one thing I will say about this, I'm going to definitely look at it. I'm getting kind of low on time here, so I'll breeze through this last section a little bit and we'll get to the live charts. But questions like this, for example, would it be considered internal? These are types of things that if you do have sufficient backtesting data, in most cases, if I have a question or something comes up in the charts where I'm like, I don't really know if I should take this trade, I have a ton of images of backtested trades where I can look back on them and say, oh, this trade kind of looks like this one that I took here. And in the long run, my backtesting data was profitable, so I'm okay with taking this trade. That simple kind of science or way that you should think about it is super, super helpful, especially when trading on your own. Of course, I'm a coach. That's what I'm here for. You guys can ask me questions and I'll look over them. And for me personally, Big Mac, I do think it can be considered internal, but I've taken plenty of trades in my personal backtesting that have a liquidity sweep like this. If the break of structure is a little bit stronger and we stay above price a little bit more, it's a great fair value gap, so I'd be perfectly okay with it. For those of you that might already be in the sell here, because I have seen some people taking this, does that make you wrong because this setup formed here? No, it just means that, you might have gotten into that bigger range, holding price to the low, it's perfectly fine. But I just want to make it clear that using your backtesting data in your trades is one of the easiest and simplest ways to answer those types of analytical questions. A good one, or a very common one, I get, and many of you have probably asked or had, is this a good enough liquidity sweep? At the end of the day, when I answer those questions, it's based off my testing and experience in the markets. But if you want to answer that question as well, you can use your backtesting data and look back and say, did I take trades that had this same type of liquidity sweep? Look through some trades, save them, whatever, save all your backtesting trades, in my opinion. But if there's too many of them, save a majority of them. Look back and just ask, have I taken trades with the same type of liquidity sweep? And if the answer is yes, then okay, it's perfectly fine for you. That type of, I guess, if-then thinking, if you want to call it that, using your backtesting, if you took it in backtesting, then take it live. Obviously, assuming your backtesting data is profitable in this case. But it really helps narrow down a lot of those unanswered questions or the confusion that can be caused in a live chart. The amount of times, of course, you guys see it all the time in chat, is this setup valid? Honestly, it can be answered so many different ways for so many different people, but I do think the easiest way as a trader, if I have the question, is this setup valid? The first thing I'm doing is pulling up my back testing and seeing, did I take trades that looked like this setup? And I think that one simple change is probably the easiest one to keep yourself accountable, but also answer questions, that may be leading to any type of confusion, as well as just overall using your backtesting data in Edge to kind of expect what's going into that live market too. If I understand my drawdown periods are expected to be anywhere from 5 to 8 trades, I got to understand that on a live chart. I got to expect the same thing. Same with win streaks or, great months versus bad months. I know what to expect for my backtesting, and I need to leverage that and basically use that as my backbone to my live trading as much as humanly possible, and I will see far more success than someone who backtests and essentially disassociates with it. They think the backtesting is busy work, and they just hop on a live chart and try to do their best. You basically have the blueprint from your 500 plus trades of backtesting. It showed that it was profitable, so use that blueprint every single day in a live market. Don't be the person that backtests 500 trades as busy work. They say, okay, my strategy is pretty good, 30% profit and 40 something percent win rate. I did pretty good that year. All right, let's throw that in the garbage and then hop on a live chart and start just trying my best. I mean, it's essentially throwing out your blueprint and trying to operate completely off of memory. Just use your backtesting as much as possible. Use the trade images that you save. Use the data that you've collected. It is literally your straight plan in how you specifically traded profitably, and you just take that and apply it the best you can to the live markets. Copy images, looking directly at images and saying, man, this looks just like the trade that's setting up on EuroCAD right now, so I'm going to take that one. I've taken one in backtesting and it worked before. Those types of scenarios is the last point I wanted to touch upon about that transition from backtesting to live. And then if you guys have any questions on the live charts, let's go over some of those now, because I am going to dive through some of my pairs. We only got about 10 minutes left. I'll go over some of my setups. This one's a good example of one that, in my opinion, was a bit ugly compared to stuff I've taken in backtesting. However, I was kind of operating similar to what we're seeing here, where I was having higher highs, higher lows. I'll mark them all out, and just kind of operating on these basic ranges here. And then I did end up taking this position. We hit my break-even point and then stopped out. So no loss here. No harm, no foul. Pretty solid setup in my opinion. I had pound USD, which was that winner. I think Andre had it as well because he sent it in team trades. He just sent something else in team trades. AUD JPY. I don't even have that set up. So there's an example of something that I personally didn't see. But I had pound USD, very, very basic, straightforward. I love these consolidation periods, a nice impulsive sweep on liquidity, break of structure created my range, huge fair value gap, strong break, and a very clear bearish trend that's occurring here. So for me, it was a no-brainer. Tapped in and 3 risk to reward there in that case. And then I had NZD CAD, which is currently tapped into. Very similar to trades I've seen before. A good example, it might have been my pound AUD trade maybe a month ago, where I love when there's these significant lows in the market. We reach just below those, grabbing that liquidity, and then we see that reversal structure. Great trades in my opinion. I love seeing these in my back testing. I've seen them work plenty of times. I think in reality it's because it's kind of utilizing that higher time frame in pair with that 4 hour. But it's just something that I see on the 4 hour chart. I don't typically care for it, but I just find that these setups work pretty well. So we'll see how that one goes. I'm in it at the moment, nothing really going on. And then this one here does look pretty promising, but I am already out of it. So I got tapped in here, ran up pretty heavily, past my break-even line, so I was risk-free, and then tapped in, and once again, another break-even trade. And that's about it that I've had recently. I don't know if you guys have had any other setups. I do know EuroCAD. I've seen a lot of people with this short position here. Definitely a bit of a longer term play, but it's another great one. Like so, 3 risk to reward. We have our break of structure from this low to this high. And then we have plenty of fair value gaps here. I'll mark the one closest to entry. And yeah, I think that's a pretty solid setup as well. Looks like it's making its way somewhat back up in this scenario, but still a solid trade. I know some people were asking about, was this the break of structure or was this the break of structure? these types of questions I think are very, very valuable to look at your back testing. I personally, when I see the liquidity is here, I consider the break of structure to be the area where this liquidity was taken and then broken. For some people, they might look at this. It is definitely a larger range break of structure, but it could just help fortify the fact that price broke this low and this low. So maybe we are more likely than not going to be moving bearish here. I think that's a solid setup. I personally did not have that one. Don't see too much else going on at the moment. Until I see some more convincing breaks to structure in certain pairs. Don't see too much going on for next week. We will see. We're heading into election times as well, so that could be, partially a reason for some of this lower volume consolidation on a lot of pairs. So we'll see how it goes. But that's about it for me. Is there any questions about the webinar overall? Of course, you guys know it'll be reposted if you missed some of it, join late, or whatever. But is there any other questions or trades I should look at? I think that's going to be all for this week. Need my water. Yeah, I tried to pace myself in talking, and I feel like towards the end there, I did end up speaking too fast again. No problem. All right. So if there's no other questions, I'm going to wrap it up here. Obviously, if any other questions roll in after I end the recording, I'm just going to answer them in this chat or DM, for example. But that should be all for this week, guys. Everybody, I hope you enjoy your weekend, and I'll see you guys in next week's webinar.